Those who do not learn history are doomed to repeat it. The original form of this statement was, those who cannot remember the past are condemned to repeat it. And, well, let's take a look at something here. Let's take a look at Ben Bernanke and the subprime mortgage economy. He said his statement, and this is on CNBC. Bernanke, he said, subprime mortgage crisis woes won't seriously hurt the economy. And he said this statement, and this is an old story I got here from the Associated Press. This story was released on the 17th of May, 2007, just before the subprime mortgage crisis hit America, and basically we all remember the rest of the story. Banks failed, the economy took a severe hit, it formed into a crisis that was known as a subprime mortgage crisis, and it was a terrible episode. So, what's happening now? Well, we've got a new chairman of the Fed. His name is Powell. So Bernanke's gone. And you remember what Bernanke said? He said, subprime mortgage crisis won't seriously hurt the economy. Well, Powell is saying something extremely similar. Leveraged lending isn't posing a crash threat. Right? It says Powell says the system is strong. Federal Reserve Chairman Jerome Powell agrees that the torrid market and high-risk corporate loans looks a lot like the mortgage industry in the run-up to the subprime crisis. So he admits that it looks the same. But he says U.S. regulators are watching closely this time around, and the financial system is better shielded. In a sweeping analysis of leveraged lending, Powell delivered a response to critics who argue that the Fed is asleep at the switch and another catastrophe looms. Despite obvious warning signs in these risky business loans, the central bank chairman said that the $1.2 trillion market doesn't represent a current threat to the financial system. This echoes of what Bernanke said in the past about the subprime mortgage crisis. This is a $1.2 trillion market. Let's read on a little bit further. We take the risks from business debt seriously, but think that the financial system appears strong enough to handle the potential losses. So he thinks the financial system, with all the problems we have in the financial system right now, we have the Turkish lira. Turkey looks like it's heading into a hyperinflation. We have the Brexit and the general slowdown of the German economy. We have a huge trade war going on with China, and China's economy is ready to roll over. The United States never really recovered from the subprime mortgage crisis. And yet he says that the financial system appears strong enough to handle the potential losses. A $1.2 trillion, that's $1,200 billion loss? Who's he kidding? Powell said Monday in remarks prepared for a Fed conference in Florida. At the same time, he said uneasiness over parallels in the 2008 crisis are understandable. Yes, I can understand exactly why they're uneasy, because of these distinct parallels. But what is also a parallel is what chairman of the Fed, Ben Bernanke, said just before the subprime crisis of 2008, and it parallels exactly what this Fed chairman is saying. The acronyms have changed a bit, he says. CLOs, collateralized loan obligations, instead of CDOs, collateralized debt obligations. So last time it was collateralized debt obligations, and this time it's collateralized loan obligations. CLOs and CDOs. But the way I see it, it's all cats, kittens. It's all the same thing, you know. It says, for example, but once again we see a category of debt that is growing faster than the income of borrowers as lenders loosen underwriting standards, Powell said. Not only is the volume of debt high, but recent growth has also been concentrated in the riskier form of debt. He pointed to mutual funds and potentially troubling participants in today's leveraged loan market, where investors have been whipped into a frenzy over eagerness for yield. This is exactly right. The world is in a frenzy right now over yield. They're chasing yield. This is why they're looking at Bitcoin. They don't care. They don't care anything about it. They look at the bottom line and they say, can this give us yield? And they say, well, heck yeah, it started in 2008 and was worth like a penny a piece, and now they're like $8,000 each. If that's not yield, I don't know what is, but they're chasing riskier and riskier forms of yield. Anything for yield at this point. So this leveraged loan market is where they're finding yield. And they're whipping themselves into a frenzy for this yield. Widespread redemptions by investors in turn could lead to widespread price pressures, which could affect all holders of loans, including CLOs and those that hold CLOs, he said of the securities that hold the bulk of leveraged loans. $709 billion at the moment. The next biggest chunk, $224 billion in mutual funds. Democratic senators, including 2020 presidential contender Elizabeth Warren and Sherrod Brown, the party's ranking member on the banking committee, have demanded that the federal agencies get a better handle on the market. Brown last month accused Treasury Secretary Steven Mnuchin and the regulators of having failed to take any decisive action. Powell on Monday argued that CLOs have more stable structures than the infamous securities of the last crisis, with regulators keeping closer watch on banks and the banks that are in much better shape, and the financial system is carrying less debt than in 2000. What? No. The financial system is not carrying less debt than in 2008. When you look at the global picture, the global debt has increased since 2008. He said that the Financial Stability Oversight Council has been having deep discussions about leveraged lending, adding that the Securities and Exchange Commission is looking for liquidity trouble at mutual funds, and Commodity Futures Trading Commission is assessing the use of derivatives to hedge risk. Sounds to me like these guys at the Security Exchange Commission and the Commodities Future Trading Commission are trying to get on top of something that's got out a little bit ahead of them already. And they're trying to figure out, they're assessing it. And they're assessing the use of derivatives to hedge risk. It sounds like this is already front run on them, and they're trying to catch up. They're like a guy who's got a car, and he's forgot to pull the emergency brake on. He's on a hill, and he goes in to buy a bag full of groceries in the grocery store, and he looks out the window, and he sees his car starting to roll down the hill, and he goes running out, and he tries to catch the car, and the car's going faster and faster. This is these guys at the Commodity Futures Trading Commission and the Security Exchange Commission who are trying to assess this whole thing. They're assessing the use of derivatives to hedge risk. It's already run away on them. So a lot of good it's going to do them to assess this if the whole economy implodes on them. The Fed chairman echoed the view expressed recently by Randall Quarries, the central bank vice chairman for supervision. Both say regulators need to find out who in the world is investing in the lion's share of CLOs. So they don't even know who's investing in these CLOs. It says both say regulators need to find out who in the world is investing. They don't even know who's investing. Both arguing that it's not U.S. banks. Global regulators have begun searching out that answer, they said. So the global regulators they don't even know. They don't even know who's buying the lion's share of these CLOs, these collateralized loan obligations. Says we cannot be satisfied with our current level of knowledge. Well, I guess not. If they don't even know who's buying them, $1.2 trillion worth, and they don't even know who's buying them? We cannot be satisfied with our current level of knowledge about these markets, Powell said. And there we leave the story to an end. Thank you guys for listening. Like and subscribe, give me a thumbs up, and we'll catch you guys in the next episode. Bye-bye, guys.